perfect. So a quick overview about SVB. We sit in between founders and VCs. We're the financial partner of choice for over 40 years. Started out in Silicon Valley. Over half of our venture-backed companies that go public bank with us. And we really like to kind of be in this spot where we can create a two-sided marketplace with investors and founders, facilitate intros, help with fundraising, and really kind of supercharge the entrepreneurial journey. Quick background. My name is Bo. I'm the director of startup banking here at SVB. Previously, I spent about a decade in operating role and product management at Facebook, Instagram, Tumblr, moved my way into kind of the CVC world, investing at Samsung. And now I help support the founders of today when it comes to fundraising, company building, and connectivity to the larger SVB and New York ecosystem. So definitely feel free to ask questions, after the event, if you want to chat about product market fit, A/B testing, all the types of product management questions you have. What was?
I think there's an echo.
There's an echo. Okay.
Let me know if you want me to mute.
All right. Why don't you mute then?
Okay.
All right. So we're probably good now. We're here as a resource here for you guys, not just as a bank, but also kind of as a platform team to really help think about how you can grow and get connected to the best people to take you to the next level. And Marissa.
Hi, everyone. Thanks for joining us today, both in person and virtually. So I'm Marissa. I'm a senior associate here on our startup banking team. So I work closely with Bo on everything that she just mentioned on helping companies to grow and scale. And then I also lead a lot of our channel partnerships. So as Bo was mentioning, we sit in between VCs and companies. So I work with VCs, accelerators, incubators, all the places where you wonderful founders may be, to bring them over to SVB so that we can then further support you guys as you continue to grow. So yeah, excited to have you here during the presentation today. I'll also be managing Q&A both in person and through our chat box. So feel free to raise your hand if you're live or to drop something in the chat box, and I'll be sure to make sure we address it.
Great. All right. I'm excited to introduce David Haber, who is our February guest speaker. He's a GP at Andreessen Horowitz, focused on fintech investments. Previously, he was a senior exec in firm-wide strategy at Goldman Sachs, leading partnerships, new venture, and M&A. And he also started his own company, Bond Street, which aimed to transform small businesses through technology, data, and design. Bond Street was acquired by Goldman in 2017, so hence why he went to Goldman. He also started his venture career at Spark, opening their New York office, and graduated from Harvard with a degree in biomedical science or biochemical sciences. So thanks for joining us, David.
Thanks for having me.
And fun fact, this is also his uniform of choice. So
a lot of Navy sweaters, which yes.
very, very consistent and lowers your daily cognitive load, I'm sure. So why are you guys here? We wanted to gather you guys as founders on a monthly basis to kind of go through the 3 whys around fundraising. So why you, the team, it's really all about the team, especially in the early stage. Why now, in terms of why market timing, you should be bringing your company into fruition. And last piece is why the problem. So thinking about, the market, your go-to-market strategy, all of that to really supercharge your fundraising efforts. So a couple of disclaimers. Obviously, fundraising is very bespoke. It's very relationship-based. So this is not a one-size-fits-all approach to fundraising. A lot of the data that we have here are going to be more skewed towards New York, and it's based off of our state of the market data from 2020 to 2022. So obviously, the data is what it is, but it should also be localized by region if you're going to be fundraising in different parts of the world. So the big question here is, a lot of stuff happened in 2022. 2021 was kind of the best year ever. And 2022 obviously had its own share of economic downturn. So the question is, where did we land at the end of 2022? So in terms of dry powder, so how much VC money is out there, it's still quite high in 2022. But we do expect, deployments to slow down in 2023. The VC investments from 22 cumulatively is down by 31%, which, if you think about it relatively, like 2021 was the highest of the highest. So I do think there's still a lot of hope out there in terms of where the markets are going, how macroeconomic markets are recovering. But would love to kind of get your take, David, how you've been thinking about the past year and future outlook, how you're advising your portfolio companies.
Yeah, I mean, it's funny to look at this graph because I joined Spark in 2011, June of 2011. And I remember in 2013, people around the table were like, oh my God, there's so much capital chasing too few companies. So it's hard to see sort of the exponential curve when you're close to the market. 2021 obviously was like pretty wild. And I joined Andreessen in June of 21. So I saw sort of like 6 months of sort of craziness and then whatever the last year of kind of austerity, and we'll see what 2023 looks like. I don't know. I mean, I think in some ways this is probably to some degree a healthy recalibration, just in terms of the amount of capital. Like we're kind of retracing back towards that kind of more linear curve as opposed to the exponential curve. And I think, again, valuations and the amount of capital that was deployed and sort of the frenetic activity that existed, at least on the investor side, was probably unhealthy or at least unsustainable. And so I think going back to a place where people are building things that, people want and valuations are sort of more in line with sort of the past, and multiples and exit multiples are sort of, again, more reasonable, I think is a healthy thing.
Yeah.
But most of what I had been focused on, again, since I joined, which I think is a slightly different experience than some of my partners, I mostly made, pretty early stage investments, right? Seed, I made, I think, one Series A deal, Series A investment. So again, my focus with the founders that I work with is like, are we building something people care about? And it's like, how do we actually find product market fit? And how do we ensure we have enough resources to be able to hit the milestones we think we're going to need to be able to raise the next round of capital, which I'm sure we'll talk about. Other partners of mine certainly, have more mature companies or businesses at, later stages that are sort of having more difficult conversations candidly about their valuation and figuring out how to sort of reconcile headcount and burns, relative to the kind of new market environment. But yeah, happy to jump into any more detail as we keep going.
Awesome. And in terms of how we're seeing the deployment of capital, it is slowing down. We usually, I would say 6 months ago, tell seed stage founders, make sure you have 6 to 12, 18-month runway at best. But now we're seeing elongated runways, budgeting 24 to 30 months at minimum, just because, there is still a lot of dry powder out there, but it is locked a little bit more. I'm curious in terms of fintech companies that you're investing in, how has runway changed for them?
I don't know that it's changed materially. Again, it's sort of more around what are the metrics or sort of milestones we need to hit to confidently raise the next round of capital. And at least what I'm advising the founders that I work with is that you should start thinking about raising your next round with kind of no less than 6 months of runway left. And so if you then work backwards and say, okay, what are the milestones again we need to hit at that point in time? What are the kind of OKRs we want to hit, in each quarter or each month prior? And that sort of, estimates the timeline. Again, folks that have a lot of cash and maybe had a higher burn are trimming some of their expenses to be able to elongate their runways because maybe the valuation that they had was quite high and it's going to take them a lot longer to kind of reach those milestones. The earlier you are, I think, it's just more about like, are you actually building something people want? And I think the focus on kind of the product and, the velocity of your product development and go to market is probably the most important thing. You can't cut your way, to a great company. You're still going to have to spend money and build business. So there's always like a tension. You can't just like shrink down to 3 people and build the company you want. So
yeah. No, that makes a lot of sense to kind of be more milestone driven than giving a finite period of time to the next round. And then in terms of seeing how valuations have, started to fall, quite honestly, I think the interesting part here from our state of the market report is, it used to be like the different categories would change a lot in terms of valuation and revenue multiples, but now it looks like fintech, enterprise, consumer are starting to converge. If you look at Q4 of 2022, obviously frontier tech is still an anomaly, given the fact that these companies require more capital and longer term, time span to mature. In terms of like fintech companies specifically, like obviously valuations are getting slashed. How are you helping, coach your founders to think about maybe you can't go out there and raise as big of a round, in terms of valuation?
Yeah, look, and I say this having been a founder, so it's not just sort of with my VC hat, it's also with my founder hat on. Raising capital and getting a high valuation is a double-edged sword, right? Like on the one hand, it's great because you take less dilution, you have more capital to prove out the milestones, again, you need to hit to build the company you want. And the less dilution you take, the more of the company you own. And if you sell, you make more money, right? That's sort of the math. The challenge is, if you set too high of a valuation, it's quite difficult to walk that back. There are very few investors who want to go in and reprice the business and do a down round. I think we're going to see a bunch of that candidly this year because valuations got so kind of out of control. But it's almost like a ratchet, right? It's like you can kind of go in one direction. It's really hard to kind of ratchet down. And it's the same, in some ways, advice that I give entrepreneurs around spending that capital, right? As an entrepreneur, you have this sort of like feeling like there's a billion things you have to get done, right? There's an insatiable pull to like throw bodies at the front. It's like, oh my God, I'm overwhelmed. I have to get shit done. And I think you have to sort of have the discipline to like ensure that the people you're hiring meet a quality bar, right? They can't just be good. They have to be like excellent. Because again, it's much easier to spend money than it is to cut expenses. Always much more difficult to unfortunately let folks go or cut burn than to spend the marginal dollar. And so I think being a little bit more disciplined with the capital that you have and ensuring that like every dollar that I'm spending has a great kind of return on that investment is important. And so again, double-edged sword in terms of setting valuations.
And I think the interesting part is a lot of down rounds are also being done quietly. So there's like an underreporting bias too. It's like we're not seeing people obviously go to TechCrunch being like, I did a bridge round. Yeah. So the stats are interesting in sense like Wilson Sonsini, like in Q3 of last year, is like 11% of Series B companies were down rounds. But you see more of that at the later stage where we have more data, but early stage, it's still kind of unfolding. Yeah. And again, the earlier you are, valuation is important, but it's less the core driver. It's more important, like, how do you actually found product market fit? Do you have sort of a go-to-market strategy that can scale cost effectively? Like, valuation becomes very important the later stage you are, because it's really keyed off of public comps or potential exit, valuation and multiples. But again, you can get yourself in trouble by setting that valuation too high, too early. Sure. Which round do you think really matters the most around valuation?
I think the hardest round to raise in my experience is the Series B. Mm-hmm. I mean, all the naming conventions have sort of changed. Like, we didn't have pre-seed when I was starting my last company. We raised $1.5 million seed and then a $10 million A. And that was like big at the time. Maybe it'll be big again, but who knows? The first round of financing is really a bet on you as an individual, right? It's maybe somebody has an intuition on the product or the market, but it's really primarily bet on the people starting the company. By A, it's sort of, have you de-risked the business? Have you proven to investors that you can recruit the right team, build the right product? Maybe, again, you have some customers, you haven't necessarily scaled the business super significantly, but you've hit some minimum viable threshold of revenue and sort of repeatability that people want to see. By the B, it's much more of a focus on the unit economics, the scalability of the business. And again, if you've set a valuation so extreme, maybe in the A, such that you haven't hit that repeatability, or you haven't hit the revenue scale to justify an up round, the metrics can kind of catch up to you, right? It's for whatever the line is, like nothing hurts a story like numbers.
Yeah.
Like, so.
Yeah, so like the narrative fundraising is probably good for the early stage, but by series A or B, it's like you hit the numbers or not.
Yeah, it starts getting real.
Yeah.
Which is fine. I mean, you have to build real companies. So you can't just raise a narrative forever. But I think in 2021, there was a lot of things raised purely on narrative, even at significantly later stages, or at least at valuations that far exceeded kind of the underlying realities of the business.
Cool.
Can I ask a question?
Yeah, absolutely.
So why at those stages are VCs like consulting startups on if the money's there, just take it? Or like, this knowledge, right? Like everybody in the valley basically does, but you still see these crazy rounds where that these people are not gonna, these companies are not gonna reach those thresholds to raise that next round. Is it like money's there, just take it? Or is like, what's the ideology to see like all these crazy rounds when most probably these people are not going to raise the next?
So I'm just going to repeat the
Yeah.
question for our virtual audience members is, despite valuations falling, like why are we still seeing these crazy rounds, in the Valley and other markets?
Or why were they even happening then?
Yeah.
So I guess.
Yeah, like with knowing what we know about like the market and the metrics you have to meet.
Honestly, I think it's hubris on both sides, right? I think there's this desire to have a particular valuation or threshold and say, okay, I'm running a unicorn business, and that, you get the Forbes magazine cover picture or whatever.
Yeah.
And on paper, that looks amazing, right? You own 30% of a business, it's hugely valued. You're like, oh my God, So I think, and then look, there is some reality that like many businesses do need a lot of capital to be able to hit the milestones that they want to build the technology that. So having more capital, I think, there's some level of psychology that's like, well, I can extend my runway, I can figure out what I need to build.
Right.
I think the reality is people end up spending a lot of that money very quickly, and so the valuation can catch up. And on the venture side, it's hard the feedback loops in venture capital are so long, right? Like you don't know if your seed or Series A investment is going to succeed and have like a liquidity event for 7 to 10 years, maybe even longer. And so the intermediate sort of heuristic for like success is basically a markup, right? It's an increased valuation in the next successive round. So if you're the seed investor and you invested in a company at a $10 million valuation, having somebody lead it at 100 feels amazing. You're like, oh my God, I was a genius. Obviously, they just priced it up 10x.
Right.
And the next person prices it up to 300. You're like, wow, I'm really, so I think there's a little bit of hubris on both sides. Again, that works until it doesn't.
Yeah.
And as a founder, again, like I always want optionality, right? Like I want to be able to gauge whether I should keep going and build a much bigger business and be able to shoot for a much bigger outcome, or potentially be able to sell my company. And the reality is that, there are very few buyers who can buy our business for more than $1 billion. And so that's sort of the tension that also exists in this market. And so the higher the valuation go, the more limited your options become, just almost definitionally in whatever business you're in.
Thanks.
And we definitely saw that in terms of, the valuations in New York too. Like it's hard to buy $1 billion, unicorn like Glossier. Like Sephora is not going to be able to buy that, So it's almost like the outsized expectations do limit the certain exit options you have.
Yeah, look, the reality is like we're in the business of trying to find the outlier companies and who can build the multi-billion-dollar, deca-billion-dollar businesses, and that's where a lot of our returns are ultimately driven from. But that's not always going to be the reality for every company. And so I'm also sort of empathetic to the need to have optionality as an entrepreneur.
Mm-hmm.
And I think it's okay, candidly, to like not have to sell for $1 gajillion and be able to have a very honest outcome that can change your life and then do it again, right? So I don't think it's black and white.
That's a quick follow-up.
Yeah, absolutely.
Not to derail, but I think that's really interesting. We actually are about to commence our Series B kickoff. I'm one of the co-founders of REZI. We're the largest leasing platform in the US.
Yeah.
And so what we do is we'll guarantee cash flow to landlords, lease up the apartments that we control, and then securitize the cash flows. So we created a financial instrument to invest in real estate through apartment leases.
Yeah.
The thing that I find most interesting is the bond market that we sell those securitizations to is infinite buyer. Right?
Yeah.
There's always size, not like equities. And since there is this infinite buyer pool, which helps us de-risk entirely, economics make a lot of sense. But then there's also this other side of my brain that's like, hey, half your competition already died in 2020, 2021. The rest are about to fail now because of the heuristic that was just incorrect based on hubris. Do you raise small and try to go for 2x in the same year because your numbers are rocket ship? You go really big for the sake of going really big to have burn, or do you actually raise to strategically start going up, picking off the hardware, the talent, and the cheap IP, because 70% of your competitive set are on the ropes? How do you find, like, where do you find the best way to answer that question?
It's hard to answer that question not knowing like the market structure and your competitive, like the competitive landscape of your business. But I mean, I think that's the dialogue you'll have with your founders and your board and sort of evaluating like, you know, the future potential of your company and the strength of your competitors, or, you know, the gaps that now exist in the market. And if you're confident that, look, now there's suddenly a gap and we have this opportunity to go fill it, then I think you can be more aggressive. And now there'll be many companies in this market who really lean in because their businesses are working, and either they scoop up other people on the cheap, or they blitz through the market because everybody else is sort of distracted with burn and expense reduction, whatever. So that's a perfectly real answer. Also, it's just very dependent on.
I just say that because predominantly that spike in 2021 cap rates went a lot to prop tech companies space, and or fintech, since we're like a hybrid. And because of that, you just are constantly dealing with could be opportunities or could be distractions. So I just wanted to ask the question.
Yeah, it's hard to give a soundbite to give a real answer, but I'm happy to chat after if you want.
Thanks.
Great. So in terms of kind of zooming into more of like the New York early stage funding, we, did see VC funding fall by about 26% over a quarter in Q2, but New York still came out quite robust with, increased funding by 15.9%, which is a total of like 866 million over 21 deals. So in terms of New York outperforming the larger dampening of the market, I would say we're in a pretty good shape. I'm curious, like in terms of how you're looking at the geographical spread of companies you're looking at and the fundraising velocity and valuation, like narratively, like is New York popping off more than some of the other geographies?
I'm biased, but yes. No, and it's interesting. We were talking about this earlier. Like I joined again Spark in 2011, started Bond Street in 2013, and then joined Andreessen June, July of 21. And so it's been interesting to sort of see the growth of the New York tech ecosystem since then. And it's probably grown 50x or something. I don't have the real numbers since I moved here in 2009, but I mean, it's grown very significantly. I think it was 2 quarters ago, we tracked kind of where all of our deal flow comes from at Andreessen within, again, just the fintech team. And New York actually outweighed the West Coast for the first time, I think ever, like 2 quarters ago, which was kind of remarkable. Given that, the firm didn't have a physical presence in New York, really until a year and a half ago, when we joined.
Sure.
So, and now we have 75 people in New York City. So it's like, I think that's sort of an expression of our commitment to New York, and not just again in fintech, we have folks doing American dynamism, we have, DevOps and lots of crypto, team members here in New York as well. So, and then other investments without, full-time folks on the ground. So yeah, the New York ecosystem, I think, is having kind of great momentum. And you're seeing that not just with Andreessen moving here, but, Index and Sequoia and Lightspeed, and there's a bunch of other kind of large pools of capital coming to New York, and then significant growth with the players that were already here.
I love that. I remember moving here 6 years ago in 2016. I had mentors telling me this is a career trade-off decision, Bo. Like you're choosing life over your career. Now I'm like 6 years later, it's great to see the center of gravity shift from Silicon Valley to New York.
Yeah. Totally.
Yeah. Cool. And in terms of how we're looking at US versus New York seed deal size and valuation, we are still seeing, you know, quite healthy valuations increase. Like the average New York seed size is around 2 to 6 million, median being about 4 million. The kind of cooling down effect of 2022 definitely affected a lot more of the later stage companies that were closer to public markets. So early stage valuation, deal size cooling down is definitely staggering here. But I'm curious, like in terms of macro data, like how are you gut checking like the deal size and valuation for seed stage company, given the fact that it's less public markets driven?
Honestly, it's more art than science. I think that's
Sure.
sort of the natural reality of the early stage ecosystem, and it's somewhat dependent on, you know, the market that you create and sort of the hype in some ways around the round that you raise at seed. It's sometimes dependent on your background and if you built a company before, have a unique expertise in this particular business or already existing traction. So it's really much more qualitative in some ways than quantitative. My guess is we'll see seed valuations and pre-seed valuations drop.
Mm-hmm.
I mean, you were seeing kind of, I don't know, $30 million post rounds get done with pretty big checks, almost pre-product and pre-launch.
Right.
I think that'll definitely simmer down, which I think is healthy. But I think to your point, you'll probably see A's and B's, you know, depress in valuation more than seed.
Mm-hmm.
So
Cool.
let's see.
And then just to kind of end on a more positive note, instead of the doom and gloom of the macro market, this is just a reminder that a lot of great companies have come out of strife. You know, in a way, constraints breed innovation. So, you know, we saw during the .com bust, the rise of social media, the Facebook, LinkedIn, Instagram. We also saw with the great financial crisis, this push towards a sharing economy, mobile first apps. So even now, you know, us being on Zoom and thinking about, you know, these hybrid events where there's for offline and an online component, I think shows how the pandemic has really accelerated how we think about, you know, our digital presence and future work and all of that. So definitely just trying to remind you guys that it is hard in the trenches right now, but there's still a lot of good things to come. So let's dive more into the tactical fundamentals of like, how are you gonna, you know, get started, close this pre-seed or seed round? So a couple of questions we really like to ask is, what round are you raising and why? You know, is this the best timing in terms of market entrance, but also your team, you know, your life stage? How are you going around getting that first VC intro, prepping for your first deck? And, you know, what should you be having in that deck too? And it doesn't have to even be a deck. It could be a one-page memo. So this is a slide that I really like to kind of spend some time on because it kind of gives you the framework of the different life stages, pre-seed, seed, series A. Obviously, you know, what David shared, a lot has changed in the last 10 years. So what would have been a seed today probably was a series A, you know, 5 or 6 years ago. But there are some like universal characteristics here. You know, pre-seed is typically pre-product, very much it's all about the team as the key, you know, reason why someone cuts you a check. That round is going to be a lot of individuals, you know, angels, could be friends and family round, could be a check from an accelerator, and it's going to be unpriced with very little dilution. Seed, we're looking at, you know, there's at least some prototype, there is some type of beta product or a wait list showing people really have demand for it. Semblance of early traction. That round is typically probably going to be a mix of, you know, angels and introducing some more seed stage VCs. And typically, you know, YC has very much popularized it's a safe note or a convertible note. And you're going to start seeing some price rounds here and there if a, you know, VC is leading that. But also, we've seen a huge, you know, proliferation of party rounds, especially during 2021 when the market was really hot. So, yeah, I would say seed right now is probably the most in flux life stage. And then for Series A, This is kind of the graduation. You're starting to grow up from adolescence into adulthood. The product is starting to scale. You are showing some, semblance of product market fit. And that's where the valuation really matters. And you're adding lead investors who are taking a board seat and taking a much bigger dilution. Any reactions to kind of how things may have changed in the last year or so in terms of life stage of rounds?
No, I think it's all still pretty consistent. I think it's important, again, putting like my founder hat on, to have. I worry about party rounds.
Sure.
Because I think you need to have somebody who, just like you're all in on your business, you want somebody who has like real skin in the game to help you succeed. And so I think having somebody like lead around or put a very material check for their fund size is quite important.
Yeah.
So if they're willing to actually step up, get in the trenches with you, help you raise the next round, build the company you want. If too many people have tiny checks and it's just sort of like a free option, I think that's quite dangerous.
And we've kind of seen that with certain companies with party rounds where like the Series A investor pulls out last minute and there is no adult in the room to really advise and save the company.
Yeah, totally. And again, like I don't know that there's like a hard and fast rule that it should be a multi-stage firm versus a seed fund. Like whatever it is, I think somebody has to have like a material check and be committed to you.
Sure.
A lot of founders have historically had an aversion to having a board member, at seed. We had a board member at Bond Street in our seed round with Satya at Homebrew, who I think is like exceptional. And it was a price round, right?
Mm-hmm.
Part of, at least for me, I wanted to be able to go to like the angel investors in particular, who were often close friends or family members, and be able to say, you're investing this amount of dollars in the company, this is how much you're buying.
Mm-hmm.
Whereas a note sort of like kicks off the valuation conversation, punts it to the next round. And again, to each their own. For me, it was always important to be very transparent about kind of what people were investing in.
Yeah.
I want to address some questions that came in our chat box. So to clarify, this is not revenue estimates. This is the amount of money that is being raised at each round.
Yes.
And yes, so it's not necessarily a cap. Like you could have a larger than 2.5 million pre-seed by chance. And then one person did ask, what would be some recommendations for founders to set up correct valuations for pre-seed startups? Is a formula that founders can use. And this is something that typically investors come to. So
yeah, again, it's sort of hard to give a very specific answer because I don't think there's like, oh yes, 10 million is the right valuation for a pre-seed company. I think more importantly is for you to build a plan for your company and say, okay, how much capital do I think I'm going to need to be able to hit whatever sort of milestones, hire the people, again, to be able to confidently be able to raise the next round of financing, and then kind of work backwards. If you're like, I'm building a really complicated product and it's going to take a much bigger budget, then maybe you need to raise more, but understand that you'll probably end up taking more dilution early on. And I would, add 25 to 30% margin for error, right? Like everything takes longer and is more expensive than you think. So, but, build a plan. How many people, what do you think you need to get ahead, and then kind of work backwards. And you'll end up backing in, I think, to that sort of dilution range.
So someone did follow up and say that they were actually asking what are generally revenue benchmarks for each of these stages, which is very sector dependent. So that
can you speak more specifically to like fintech, how you're thinking about revenue markers?
Yeah, it depends. And fintech is like a fairly heterogeneous space where you have, lending revenue versus SaaS revenue versus payments revenue. It's not all of that is created equal, in my opinion. I think the only stage that has sort of a clearer demarcation in some ways for a revenue like minimum, it's probably the Series A. And I would say the most common number people seem to be throwing around now, and that wasn't true certainly in 2021, is probably like 1 million in ARR. And by ARR, I mean like run rate revenue, even not necessarily like book revenue. Again, rounds have been done at our firm at lower than that, and many done significantly higher than that. And so these are sort of moving targets, but I think you want to be able to show some real revenue by the A. pre-seed and seed, as we talked about before, is really still primarily bet on people,
Mhm. Sure.
people and product.
All right, so in terms of the, when is the best time to raise? I would say, back in COVID days when we were all on quarantine, like Zoom, any day is good, but we are starting to shift back to the seasonality of fundraising where you're gonna see, holidays, summers, partners taking off for vacation. Definitely really buffer in the time in which you're thinking about starting to have those conversations. One question we get asked very often is, how do I have lightweight kind of, testing the water, informal conversations with VCs without having them, making a decision on the company then and now?
Yeah, I mean, I think it's good to have coffee conversations months before you're thinking about raising and getting
Yeah.
their advice in the market, the observations they're seeing, pressure testing ideas you have. And it goes both ways, right? You can make intros to the VCs or share observations you're seeing in the market. I think as with a lot of business, these are relationships, these aren't
Sure.
transactions. And so and by the way, I think it's super important, even when you do decide who to raise from, these are very long-term commitments. So you want to make sure you actually have a really good relationship with the individual partner, in my opinion, even more than the brand. And I say this, we have a good brand, but like it's really important that there's chemistry on both sides from the partner and the entrepreneur. And you want to be able to test that, not just in the 2 weeks when you're actually like fundraising,
Yeah.
but in the many months before that.
So how do you facilitate like these safe spaces to kind of talk and pitch about your company without the VC automatically thinking like, is this a go or no go in terms of decision making? Is that like conversations without a deck, talking about the space?
Yeah, I think it's any of that. I mean, and we have conversations with entrepreneurs all the time.
Sure.
Outside of the context of like a formal fundraise. Typically, there's no deck.
Yeah.
I would say they're still evaluating the entrepreneur, right? Like any conversation is sort of an opportunity to make a good impression in both directions. By the way, we're selling as much off the entrepreneur as they're pitching us. So, but yeah, it's typically a conversation on your space. It's sharing your thesis. It's articulating the plan and vision that you have for the company. The best thing, even as a VC, is to be able to, having met an entrepreneur 6 months ago, they sort of outlined what they wanted to accomplish. They come back 3 months later, they've accomplished what they said they were going to accomplish. They come back 3 months later, they really accomplished what they had set out.
Yeah.
And like you've laid sort of the breadcrumbs for what the business would look like. That makes it very easy in some ways to be able to like lean in and pull the trigger.
Sure.
It's harder again to have all of that context when you're meeting somebody in just the narrow window again when you're fundraising.
Got it.
We're also open all year long.
Right. 24/7. Yeah, go ahead.
Are update emails helpful? Do investors actually read them?
100%. Yeah. And I think it's good hygiene as a founder to be able to send, monthly update emails. I would write them assuming that they are shared. But often that's like, you see this happen, right? Like people send a monthly update and then you start getting inbound from other VCs and, but again, I think it's just useful to be able to show people what you said you were going to accomplish, show sort of traction over time. And I forget who said it, but people invest in like lines, not dots. Like it's sort of the same.
Yeah, I've personally invested in companies that you see the delta in 6 months, where like the pitch deck you saw 6 months ago has changed so much after the conversations they've had and taken feedback that you're like, wow, this like founder is really on like a growth trajectory here. So,
and it doesn't mean that the business has to stay exactly the same as what you predicted. It's okay to change and pivot and sort of find your way. But I think it's what people are looking for is like, the learning and sort of velocity of your kind of evolution, not just sort of a linear, path necessarily.
Great. So in terms of how you're thinking about structuring your sales funnel of reaching out to different investors, I always say, fundraising is like enterprise sales. Like you really need to think of it as a numbers game, but also be able to refine and iterate at every single stage of your pitch. So we highly recommend, starting out with like a pretty large database of qualified investors. That could be 30, that could be 100 for folks, but really think about the order of operation in which you're reaching out to folks. There are safe people to pitch to, like angels, friends and families, mentors, advisors, and then work your way up to, thinking about the Andreessens of the world. Hopefully it's getting to that like critical mass point where you do get a lead investor, which is the tipping point for the round. In terms of like how you're thinking about qualifying the list of investors, these are some variables to think about. A lot of this information is public and online. So we highly recommend doing the research. Like, do not reach out to a late stage, growth investor around a pre-seed round when they clearly have talked about their sector specialization. The more nuanced variable I do want to call out here is the vintage of a fund, because usually that's not public information. So thinking about the deployment period of a fund, it's going to be way more hot and hyperactive in the beginning when that fund is closed, and they're going to have smaller and smaller checks at the end. So it's okay to ask, is this at the end of your fund? How are you thinking about the deployment velocity of this fund? Are you holding out, for some big investments for the next fund? And it's okay to also ask, like, do you lead, especially if you're hunting for that lead investor check. Curious, any other variables, that we might be missing here in terms of qualifying folks to reach out to?
I think thesis area, and maybe it fits within sector,
Sure.
but one of the things we do a lot of is publish content, like pretty publicly around our thesis areas. And, we've written a lot on prop tech. So you could, when you have a conversation with an entrepreneur, it's another, by the way, good way to have an informal conversation is sort of a reaction to the piece.
Yeah.
Right. It's like, oh, I actually disagreed with your market map. Here's how we're positioned in this space. But to understand, okay, does an investor have a particular point of view within the space that you're building in, I think is also a helpful kind of qualifier. And it helps to have done a little bit of homework, in my opinion, on that, and looked at the other portfolio companies that may have invested in the category, read some of the pieces. And again, you should assume that they've done work too, and hopefully they've heard your company, or at least have a point of view on your category as well.
What about competitors? Like
mean?
reaching out to investors who have invested in competitors of what you're building.
Most VCs, or at least good VCs, in my opinion, like have a pretty hard and fast rule of not investing in direct competitor. So if you believe that it's a direct competitor, it's not so much that you can't have a conversation with that person, but I would say it's a very low likelihood that it'll convert to being an investment. It happens, and companies pivot to compete with each other. And this is like a reputation business and relationship business. So even if we need somebody who's directly competitive with another company, it's not like we're sharing information across portfolio companies. But again, like, we'll be pretty direct in that first meeting and say, look, we have an investment in this other business. Like, I think it's a competitor, but ultimately it's up to you and maybe that entrepreneur. And so, but I think that's good homework, to do in advance for sure.
Right. And then this is kind of the, quest is finding that lead investor. And I always kind of joke, it's like the Pareto rule, like 80% of the outcome comes from 20% of your effort, sometimes finding that fulcrum of landing the lead. And it's going to be a slog, in terms of like getting a bunch of no's in the beginning, having people who maybe like talk to me later after you get a term sheet. So if you're really thinking about getting to that lead investor, tipping point, like there has to be heat in the round, which sounds very subjective, but like from a human psychology standpoint, like so much of fundraising is like, do you have enough FOMO in the game in terms of like, if an investor passes on you, they feel like you may go to another competitor. And all that is really a function of how many other people are committing at the cap table that are signaling, this is going to be something that may close really quickly. And once you do get that one term sheet, oftentimes you're going to get multiple term sheets at the same time. And that's kind of the ideal scenarios, you can make an option between different term sheets and valuation. But I'm curious, like when raising Bond Street, like thinking about getting to that tipping point, like what was transformative for you, and what do you advise, founders, who are chasing for that tipping point to do?
I mean, I think some of the advice you gave is all accurate. And I think, even potentially starting with angels or folks that can't lead around but are very connected in the space is a good way to sort of build momentum. They can be the, kind of neutral folks to introduce you to an ecosystem and kind of, get the fundraising process started. As a founder, candidly, like the thing I wanted was like somebody to invest with conviction.
Mm-hmm.
So not so much on FOMO because who else was around the table. It's like, do you
Right.
actually believe in what I'm building? And often I would trade that over valuation.
Yeah.
Like, do you have a thesis for what I'm building? Do you have conviction in me as an entrepreneur? Like, that's the person I want.
Right. Because that's a long-term marriage.
100%.
Yeah.
And like, just emotionally, like you want somebody in your corner,
Mhm.
not just when like things are hot and momentum is up and to the right, but like reputations are built when like shit hits the fan. And, a lot of stuff broke candidly at Bond Street,
Mhm.
and the people that I would raise money from again, if I started, were the people like in the trenches with me who had conviction, not the people who were sort of investing because of FOMO.
Yeah.
So, again, it's a two-way, like you're diligencing the investor as much as they're diligencing you. And, I wouldn't think about it any other way.
Sure.
That said, it is helpful to sort of create the momentum and, just to kind of force action, because
Yeah.
they're seeing lots of different companies. You're raising for one, you want to make sure there's like a bias towards action,
Right.
one way or the other. Like,
I do like the point you bring up about raising during hype cycles versus down cycles, because the FOMO really played in the last 6 months in terms of getting into the hottest deals. But now you're kind of looking for these like wartime investors who are going to be there with you in the trenches.
yeah, and I hope that was always true, but you're right. Like,
Yeah.
certainly in 21, people I think were investing with momentum,
Mm-hmm.
kind of believing that the next marginal round was always going to happen.
Yeah.
And not necessarily having like deep conviction in the investment they were making. And again, these are like, as a founder, these are human relationships. They're not call options.
Right. That's good. Yeah. We're not trading margins here.
Yeah. So like, again, both directions, like
Yeah.
you're not just raising dollars and at a valuation, you're building a partnership with another person. And so you want to make sure that you're aligned. And look, maybe we'll get into this, but people pass for lots of different reasons, which
Yeah,
I'm happy
we're
to-
definitely going to jump in. So we kind of what David mentioned in terms of setting yourself up for finding a lead, getting a network of angel investors, who offer a lot of human capital, operators who have networks into the larger funds that you want to be pitching to. There are oftentimes, safe spaces for you to talk to and kind of act as a soundboard. And you're also, as an angel investor, I'm biased about this, but like you're also getting a lot of human capital, like people who are experts of their own field that can help you quite tactically with, your product market strategy, your go-to-market strategy, branding, et cetera. But this is the part where, getting the intro here is kind of not all intros are equal. And, we've kind of talked about just get the intro, but in terms of like the strength of signal of where these intros are coming from, this is like a little bit of the nuanced part of fundraising, where I always recommend with founders, if you can get into the founder whisper network, that is like the strongest strength of signal, because these are founders VCs have invested in that are saying great things about you and can vouch for you. And VCs really do listen to their portfolio companies. The other strong signal would be a trusted partner, advisor, through SVB, through an attorney. And then we start getting towards the cold outreach, which I'm not going to rule out, because I've also seen founders craft these incredibly personalized, well thought out cold outreach emails, kind of to David said, like responding to a market map, teasing apart a thesis, shining new light into how you can further a partner's thinking. And then, the last, please do not take the offer is sometimes VCs will say, hey, this is a no for me, but can I pass you along to other folks? And if you think about the human psychology again, if someone says no to a deal and passes it along, their first question they get from their investor friends is, why did you pass? So that automatically starts to bias, future investor intros. But any thoughts and reactions in terms of like how you like to get your intros or to have founders reach out to you?
Yeah, I mean, I think in general, this works. I wouldn't underestimate a good cold outreach or, Twitter
Yeah.
DM or Twitter reply. Like, there's a lot of ways to start conversations. Like, in general, in my opinion, VCs are very accessible.
Mhm.
Like, there's a lot of ways to get intros. I don't really think it's humbly
One
speaking, like, all
avenue is
that
better than the
challenging
other.
or
Yeah.
but yeah, certainly like a portfolio founder that you work with and trust, like having them introduce you is probably the highest signal. I tend to agree. Yeah, and existing investors is sort of like table stakes
Mhm.
in some ways, and that's often like how seed investors pitch themselves. They're like, look, we're taking a bet on you at the beginning, but we also know all the other kind of larger firms. Like, they're typically quite well connected and can easily facilitate those interests. A lot of our deal flow certainly comes from earlier stage investors from where we sit. But I personally like when people sort of reach out and are willing to debate, or have.
So you guys got to slide into
Yeah.
those DMs,
Yeah.
All right. In terms of how you're prepping for that first meeting, there's a lot of different ways to really think about how to structure that conversation. One is obviously coming with something prepared, like a deck or one pager. But also be ready to be nimble and dynamic. If you're meeting someone, in a coffee shop and you can't go through your 20-page, deck, like be ready to be able to like spontaneously pitch. Also really do your homework, know the thesis, know where the investor is investing in their life stage. And at this stage, because these companies are so young, do not ask for an NDA. It's just like really not necessary. And also know that this is a very long-term relationship you're building. Like, it's not going to become a yes or no decision in the first meeting. And kind of, I loved your story of like, with Bond Street, you were giving 6-month updates to potential investors and buyers. And it was kind of like nurturing that relationship over the years, right?
Totally. Yeah, I mean, we were, I forget, is it Rhett? Yeah, Brett and I were chatting earlier because you would ask, like, how did you sell the business to Goldman? It's the same, in some ways it's similar to fundraising, albeit probably longer timelines. Again, it was, to your point, like building relationships with people for a long period of time. And, I'd met the person who ultimately led the transaction in 2014. He went on to build what became Marcus. I went to go build my company, but I would update him. We'd grab coffee every 6 months. He had all of the context of 4 years essentially before they kind of leaned in and pulled the trigger. And I think it's important to, you don't want to spend all your time talking to potential acquirers, but I think it's important to spend 5 to 10% of your time building relationships in the ecosystem, because if you have 6 months of runway and you expect to get a deal done, it's like virtually impossible, to actually make work. It's more on M&A specifically, less on fundraising.
Great. And then in terms of like what goes into the pitch deck, some of these variables we've touched on already, but like having a really clear problem statement, your go-to-market strategy, why the product that you're building or service, resonates with the market. The team is really going to be heavily weighed. And obviously, having too much of an emphasis on your team's background in the pitch deck and not talking enough about the problem, the solution can be, a downside too. But having enough information to really frame to the investor, like why this team is uniquely positioned to tackle the market. Because in the grand scheme of things, there are a lot of great teams that lose in bad markets, right? So the investor is really thinking about the team, the market, and also like the product. So you can have a great market entrance and a mediocre team and an okay product and be the first mover and still do really well. So there's a lot of variables that the VC itself is, thinking about. Curious in terms of like when you're looking at a pitch deck, like what catches your eye the most?
it might come out in the pitch deck or might come out through questions. It's more of this notion of like, has the founder gone through what we would call like the idea maze?
Mhm.
Like, how deeply have they thought about this problem? And you can, in my opinion, pretty quickly tell whether somebody has like encyclopedic knowledge of every prior failed attempt at building this type of business, because inevitably there's lots of failed attempts at building whatever idea or adjacent idea. And if they have a very clear point of view, or what we would also call like an earned secret, in terms of like what their unique strategy is in tackling this problem, or something in their prior experience that sort of gave them an insight to be able to go build this company. Like,
Mhm.
again, if you can articulate that in the deck, that's amazing, but that also often comes out in conversation. But those are the things that we also look for, is like, have you gone through the idea maze and you have an earned secret?
Yeah,
And everything else I think is true, but those are also qualities that we look for.
I love that framing, earned secret, like that only comes from the lived experiences of having like built things and thought through all the different iterations.
Yeah, I mean, one of the more successful investments that I made when I was at Spark was in Plaid.
Mhm.
And they built, they didn't start out actually building a bank data API. They built a PFM, which is like mint.com basically. And then recognized that actually aggregating transaction data was really difficult. And yet there was a lot of other attempts at building sort of a PFM. And so they saw an opportunity to spin out the infrastructure as its own company, but that was again an earned secret
Sure.
from having tried to build, the consumer product. And so Angela, one of my partners, has written a lot about like lots of fintech companies end up spinning out their infrastructure.
Mhm.
I forget, she had a better line for that, but a lot of that again comes from the earned secret of trying and failing at something and then pivoting the business or anyway.
Yeah. So it's a lot of it is just like coming from the growth mindset of like, I have failed in XYZ and I'm going to take new information to light
Totally.
and iterate on it to produce like what hopefully will find product market fit.
Totally. The other quality is also like, why now?
Yeah.
Like, I think people will ask, why is this unique point in time? Sometimes it's a technology shift.
Mhm.
Sometimes it's a secular trend that's happening in a given space, or new regulatory changes, but that's another kind of good catalyst, both for when you were initially starting a business and also, maybe we'll get to this, I'm not sure, when you're fundraising. Like, is there a particular catalyst that is sort of a good moment in time to go out and actually raise capital?
Yeah.
Could be a new partnership, could be a product launch, could be traction. It's better to raise at some sort of inflection.
Sure.
Than
So we actually did get a question submitted around bootstrap businesses, like when you should think about going out to raise money, especially, at the A and beyond. Like, how are you advising companies that maybe didn't start out venture back, but at some point are like, oh, I need this money in order to unlock the next, life stage of growth?
Yeah, look, the reality is like, there are a lot of ways to build companies and be super successful. And honestly, the best way to scale your business and raise capital is through your customers. Like, just sell product and generate revenue and have good margins and grow the business. Like, if you can avoid venture capital, I think that's like, you own 100% of your company, like, power to you. You can make a lot more money in some ways owning 100% of your business than 10% of your business. It's easier to sell a $100 million company and own 100% of it than own 10% of a $1 billion company. So that said, venture capital obviously plays an important role, and there's some businesses that really require significant upfront investment, and you're not going to be able to build a profitable business for a long time. Or, maybe you see, a market dynamic where you really want to put your foot on the gas and you don't have enough profits to be able to do that, and so you want to go out and raise capital. Again, no hard and fast rule on exactly how to do that, but I will say taking venture capital dollars does put you on a different trajectory, right? It's much more about just, you think about the sort of incentives of a venture firm. It's really about finding the right tail outcomes and generating significant profits and having many fail.
Right.
But in an effort to try to find those outliers. And so not every fund operates that way, but I think it can put you on a more binary path than one. If you had a sustainable business that was already profitable, maybe you actually raise debt financing instead of raising a ton of equity, or anyway, you limit the amount of controls or rights that the investor had
Right.
when raising that capital. So
So there are trade-offs in
100%.
terms of like how much ownership you have of your company versus relinquishing ownership as you raise along every single tranche.
and a good example is, so again, Bond Street, the business that I had started, was a small business lender. So both we were raising venture capital, we also raised like hundreds of millions of dollars in debt capital, but then we were financing coffee shops, small business
Yeah.
owners, all different types of companies. I think our like 9th or 10th customer was Tuft & Needle, if you've ever
I
seen.
love their mattresses.
Yeah, so they were one of the first movers in like the D2C mattress game. Didn't care about venture capitalists. They were based in Phoenix. They, Dahi and JT were the founders, bootstrapped the business with like $8,000 of their own money. First year they did like $1 million. They started in, I think, 2011 or 2012. They did $1 million in revenue in the first year. They did, I think, 4 in the second. We lent them $500,000 to open up a physical location in San Francisco. They did, I think, 8 million that year. Then they did 40, then 150, and they sold. They owned 100% of the business. They
Wow.
sold for something like somewhere between, I think, $500 to $700 million
That's
to
incredible.
like Serta, Simmons, one of the big private equity conglomerates. Meanwhile, Casper raised hundreds of millions of dollars in venture capital,
Mhm.
went public, and then we're trading below cash.
Right.
Like not taking anything away from those founders. They
Yeah.
built still a super impressive business, but like maybe it was actually a better decision not to raise venture capital.
Right.
And so I think
right.
not every business, in my opinion, requires venture capital. I think venture gets a lot of hype and
Mhm.
brand,
Of course.
but there's a lot of really great companies that you can scale with your customers.
Yeah. Yeah. MailChimp is one of them too.
100%.
Like he
It's
raised
rare.
1 round and that was it, but like, we're not in the business to be like, you guys should take more VC dollars, it's more like if it is the right modality for you after thinking about all these trade-offs and individualizing it to you as a founder of the type of company you want to be building. And also just like the long-term trajectory, like a sustainable business, is probably not going to sustainable in the sense like you don't have to keep 10xing every single year is probably not going to be on a VC backed journey. So I do think that is the caveat here in thinking about taking VC funding. And then we are over time. So I do want to be mindful of kind of skipping some slides here. I want to close out in terms of ways for us to continue the conversation here. So, on our startup banking team, we do offer access to VCs. These are for our clients that work with us and bank with us at SVB. So these are going to be, bespoke events, pitch, networking events, as well as we offer our founder success team. So Marissa and I, along with our team of founder success folks, we are in the trenches advising your companies, thinking about, a lot of these types of like deliberations you're talking about. Should I raise another VC round? How should I be, structuring the terms? We also, are able to kind of connect you to other experts and VCs and founders who have kind of, come before your path and done similar things. And then the last part is just as a follow-up to the event, we will be sending you guys all an invite to Orbit, which is a one-to-one matching platform so that you can learn from another founder who has attended the workshop and, really kind of continue the conversation that way. So thank you all for joining us. And thank you, David, for contributing your insight and learning.